Welcome to this week's current federal tax developments for the week of January the 14th, 2019. I'm Ed Zollers, broadcasting from here in Phoenix. And this week's broadcast is brought to you, as always, by Kaplan Professional Education and by your state societies of CPAs. This week, again, the government shutdown is still in place, so we're still, not having a lot of things coming out of developments. The tax court's not holding hearings. Things are slowing down a bit, and we haven't yet got, yes, I know you're waiting for it, the 199 Cap A final regulations. Nope, still not out. But we do have a few things happen up. The IRS did reopen the income verification system for mortgages and some other fee-based programs, despite the fact we have the government shutdown in place. We're going to talk this week about the syndicate rules. I'm going to talk about that in the context of Section 163J. This was triggered by an article that showed up in Tax Notes this week, but it actually applies in a few other contexts as well. And we're going to tell you about why, even though you may say, wait, none of my clients have revenue of over $25 million, we may nevertheless still have a problem with the interest limitation rules. We'll talk about, hey, remember that thing we told you about the Realtors? And they might be a specialized service, trade, or business. We need to go back and revisit that here for a second. IRS has a change of mind, or at least change of publication. Filing season, we know when it's going to start now, despite the government shutdown, and refunds are supposed to come out. And finally, we also have a change this year in the address to send our gift tax returns and estate tax returns. So as I say, interesting little details this week. We'll talk about what's going on, get ourselves started here. But again, welcome in. It is tax season is coming up on us, good news or bad news. We have tax season approaching. And as that approaches, of course, all the fun we have with that. Here in Arizona, the bad news is in the Phoenix area, weather is great during tax season, which is kind of depressing because we're stuck inside. And it's somewhat nicer to be someplace where it's apparently so lousy outside you don't want to be there. Well, hopefully, we'll see how that works out. But the tax season is coming up. Everybody's hopefully getting ready for it. We're getting our pieces together. IRS, as we're going to say this week, we're going to tell you the tax filing season. We have an opening date, even if we still don't know a whole lot of things. But hey, we can start on something, I guess. So let's go to our first development for this week. The first development is an IRS statement. The IRS is going to reopen IVES, which is the income verification system, and they're going to open some other fee-based programs. The idea was that these programs are going to be reopened for various reasons. One of the big problems that people are running into is the income verification express services system, IVES. That's used by basically mortgage companies to verify home mortgages. Verify that you actually have the income that you claim you have. Now, the problem is, since the IRS went into government shutdown mode, now 22 days ago as I record this, we'd been unable to get that information. That was causing a bunch of mortgages to sit kind of pending, waiting for the government to reopen. That doesn't appear to be happening real soon now, at least today. Who knows when that'll change, and probably when it does, it'll be very rapid, and suddenly we'll have a government open. But for right now, it doesn't appear likely to change. So the IRS did say that they're going to reopen the program. However, they also noted that they have a backlog to work through, right? Because of that backlog, it's going to take longer than normal to get these turnarounds from the start. They noted that they got restarted on January 7th. They had a backlog going back to December 22nd. So this backlog means they're trying to work through that and then get back up to speed. So yes, we may still not be as quick as people had been used to. They also have opened up other fee-based programs. The particular one they were opening up that people were interested in is to get a copy of your tax return. If you need a physical copy of the tax return, the fee-based program for that is now reopened, and apparently you'll be able to get you'll be able to get copies of the tax return now. So that's probably good news for you. Next up, this one was triggered by an article in Tax Analyst, Tax Notes, and this was Tax Shelter Rules Tee Up Tough Decisions for Smaller Businesses. This is Tax Notes today from January 11th, 2019. Now, here's where the problem comes in. The problem is, we all know about there is that 30% interest deduction limitation rule. But a lot of people read that and said, if you work generally with small and medium-sized businesses, small and your medium-sized business is one that is basically high margin or service, so that you're not doing a low margin business. And you looked at that $25 million gross revenue and you just basically said, doesn't apply to any of my clients, don't need to worry about it. Well, the problem is that might not be true. Okay. 163J, our wonderful code section here that deals with this. Okay. It tells us that in order to get out of this, we have to be able to meet the exemption for small taxpayers that's found in section 448C. But that exemption for small taxpayers in 448C only applies if your revenue is below 25 million. Well, that's great. But also it doesn't apply to something called a tax shelter as defined in section 448A3. Now, if you look at that, and by the way, you probably want to get the write-up for this, either go to the website and read the article on there or download the PDF we always put with these weekly updates. You probably want to go get that because I'm going to walk you through each of the sections. If you try to follow that, it does get a little involved, but let's try to follow it through. What exactly are these tax shelters? Okay, well, the great thing about this whole section we discover quickly is this is the perfect illustration of the love of the IRC, of the tax code. When Congress writes these laws, they cross-reference all the time. And, well, here, we start off here. In 163J3, we're told to go look at 448A3 for what's a tax shelter. Okay, that's our first cross-reference. If you're new to this, you might expect that when we go there, we'll get the answer. It'll be crystal clear and we're done. That's not how this works. When you go to 448A3, what you discover is that you're told the term tax shelter has a meaning given the term by section 461I3. And then there's some special rules about an S corporation in certain situations wouldn't be a tax shelter. If it's going to fall under what will be the first category of the three that we get to there under I3. So, okay, we're still bouncing around. Now we go to I3. I3 tells us a tax shelter is any enterprise other than a C corporation if at any time interest in the enterprise has been offered for sale and offering required to be registered with a federal or state agency having the authority to regulate such sale. Except, please remember that we're told in our first, going back to A3, the exception that as an S corporation will not be treated as a tax shelter for purposes of this section, merely by being required to file a notice of exemption for registration with a state agency, but only if there is a requirement applicable to all corporations offering such security for sale in the state that to be exempt from such registration must file a notice. So, okay, two links there. That gets the first one out, but that's not really our problem one. And there's a third category here too. There are three categories. The third category is any tax shelter as defined in 662 D2CII. Well, that definition of a tax shelter, which by the way should sound familiar to anybody who remembers the old Circular 230 disclaimers all over the place. A tax shelter is a partnership or other entity, investment plan arrangement, or any other plan arrangement, if a significant purpose of such partnership entity plan arrangement is the avoidance or evasion of federal income taxes. Now, in IRC speak, avoidance is what you'd probably call tax planning. But again, it needs to have a significant purpose. So if there's not a significant purpose, if you just bought a building, right? You bought a building, you're leasing an office building. It was not a significant purpose of the structure of putting it inside an LLC that's owned by 5 people. Probably wasn't the tax benefit. You put it inside the LLC primarily for liability protection. And we have it owned by 5 people because, hey, we need 5 people to buy this thing. So I'm going to say that won't catch us. Hey, that's good. But there is a third category, this thing called a syndicate. And this is nothing new. We've had a problem with this definition on and off for years because, remember, it has always blocked us from using the tax basis of accounting for a small C corporation. And it also pops up other places to stop us from doing certain things. So we have this weird concept of what's a syndicate. Now, you might say, well, it says within the meaning of section 1256E3B. Okay, more cross references. So we go back there and we take a look at, okay, what does that say? Well, here's the catch of what a syndicate is. A syndicate means any partnership or other entity other than a corporation, which is not an S corporation. Okay, don't worry about that. If more than 35% of the losses of such entity during the taxable year are allocable to limited partners or limited entrepreneurs. Okay, well, we're an LLC. We don't have limited partners. But do we have limited entrepreneurs? Because let's face it, if the rental loses money, right, we're going to allocate it among our 5 members. Are any of those members limited entrepreneurs? Well, you might go, what in the world is a limited entrepreneur? Cross-referenced again. Within the meaning of section 464E2. Another cross-reference. It's always fun in the code. So now you go look for 464E2. I'll give you some time. Yeah, keep looking. You're quickly going to discover there is no E2. Well, okay, here's what happened. In 2014, Congress repealed 464E2. Okay, that seems like a problem. What they really did was they picked the definition from there up and moved it to section 461K4. Yeah, that's the same section we had been at just before here, right? We're now kind of circling back on a section we had previously hit, though a different part of that section. Okay. Now, actually, it wasn't even 461K4. They initially enacted it as 461J, but didn't get rid of the old J, and they didn't have any K. So it was actually finally fixed in the 2018 Consolidated Appropriations Act, finally made this section 461K4. Everybody presumes that the cross-reference should be updated to 461K4, but Congress has never actually done it. Okay, so little detail there. But let's go ahead and let's assume for practical purposes that's where we're going. So again, remember, if 35% of our losses get allocated to this limited entrepreneur, or to use the term that's actually in there, right, are allocable to those people, then we have a problem. We have a tax shelter. If we have a tax shelter, we can't use the cash basis of accounting. If we have a tax shelter, the 30% interest limitation rules of 163J that you all thought, hey, this doesn't apply to my clients because they're not 25 million, are suddenly in play. So here's the catch. A limited entrepreneur means a person who has an interest in an enterprise other than as a limited partner. Well, we knew that because limited partners were already in. That's fine. Does not actively participate in the management of such enterprise, and does not actively participate in management. So now this gets more interesting. So I've got five people who own this office building, but only one of them is a manager. The other 4 are members, right? And these members don't really do anything. Now, do we have a problem? Potentially. Now, this has been around the code for a while. First thing is we do have a little bit of an out, the section 1256E3C. There are some safe harbors that provide certain interests are not going to be treated as a limited entrepreneur, right? In essence, any interest won't be there for any period during such period. The interest is held by an individual who actively participates at all times during such period management of the entity. Well, that kind of was already known. And for any period, if during such period an interest is held by the spouse, children, grandchildren, or parents of the individual who actively participates at all times during such period. So it's a kind of attribution that helps us. It was held by an individual who actively participated in management of the entity for a period of not less than 5 years, even if they're not currently doing it. Okay. If it's held by the estate individual who actively participated in the management of such entity, or it's held by the estate individual if with respect to such individual, such interest was at any time where we have the relatives who've been actively participating, or if the IRS, Secretary determines by regulation or otherwise, such interest should be treated as held by an individual who actively participates in management of such entity, and such entity and such interests are not used for tax avoidance purposes, then it won't be this. Okay, but it seems like we still got a problem. Now, PPC's limited liability company volume of its tax financial planning library, there's a section in there which you'll find if you want to take a look. If you haven't accessed that library, it's at paragraph 805.24 there. There have been a series of private letter rulings on this that mainly go back to the 90s and that take a look and give us some guidance about what is and is not considered to be a syndicate type situation. What's a limited entrepreneur? And we have some rulings that tell us that if it's an LLC, where everybody's in the profession that the LLC does. So you have an LLC, you're an accounting firm, and all the members are CPAs, right? They're all participating in that. Even if, in fact, management's limited to just, maybe one or two people, that won't be a problem. Well, hopefully we're not losing money there, but we'll talk about that later. If management was vested in the executive or management committee or the like. So we have some rulings there. Those 95-01-033, 93-21-047, and 93-28-005. Those are private letter rulings. If you have those, then we've held that that's not going to be a problem. If the LLC always reports income and is not expected to report losses, it's been held to be fine. Or if in a case where LLC had non-equity members, where less than 35% of the losses would be allocated to such non-equity members. In these cases, they all work. Now, an interesting aside, there is a definition here. It also pops up in section 448. And the regs on 448, remember I said they talked about losses allocable. The regulation talks about losses allocated. And you remember those sets of private letter rulings that talked about LLC that always reports income, is not expected to report losses? Here's where a hitch comes. It appears under the current law, if your entity reports income, then it's not a syndicate for that year. And the interest limitations, therefore, would not necessarily apply because the $25 million rule would come into play. However, the year you have a loss, then you may very well become a syndicate. Okay. Now, again, for an accounting firm, that's not really probably a major issue. If you're talking about a true partnership operated accounting firm, hopefully we made some money after paying the staff, even if it wasn't what the partners would like to make. But presumably, but if you have a real estate operation, it could very well lose money in some years. Or any other type of operation. And here's the hitch. In the year in which it loses money, especially if it's a real estate operation, you now have a choice to make. Remember, real estate operations can get out of the interest limitation if they elect to use ADS, but that election is permanent, and that means permanent even if later we qualify to get out of this rule. You want to take a look at the syndicate rules if you've not looked at them. Now, as I say, they popped up over the years. The IRS has done a lot in those private letter rulings and the regulations to kind of get this thing out of the way, because it's always been a weird little rule, and I've never really seen it come up in practice where it's become an issue. But under the interest rules, it definitely now could become an issue where we have this interest, because again, it came an issue before in things like, well, if we had a, C corporation, small C corporation, cash basis, well, don't have many of those, right? And it moved out of the way for certain things. So we didn't have real problems with it. It didn't apply to professional entities. It's like, so, it just wasn't a problem. But unfortunately now it's a problem. So what we're going to have to do is take a look carefully at this and see whether or not the IRS gives us some better guidance on what a syndicate is. Clearly, at this point in time, we need better guidance on the topic, because 163J is important. But if you've not looked at the syndicate rule, you might want to look at the syndicate rule. At least have an understanding of how the syndicate rule works. Okay, next up, we have here, the IRS. Hey, remember last week, we had a simple rule here where, whoops, getting back to the wrong thing again. In this case, we had the realtors. Now, here's the catch. What we're looking at here for our realtors, and I just kind of realized that my slides appear to have a little bit of a problem. So for those of you who are watching, we will hope, well, I hope for the best, but I don't get it. If you remember a week ago, so we just won't have a slide for this that works out the way we want to. So here's the catch. You remember in publication 535 last week, okay? We talked about that. So we're talking about the draft of publication 535. That draft publication last week told us that included in specified service trade or businesses were real estate agents and brokers, insurance agents and brokers. As I pointed out, we talked about that. That was a break from what the proposed regs said. But the December draft version of Publication 535 had this special language, and suddenly they were in. Quietly, on January 7th, a new draft version of this portion of Publication 535 appeared on the IRS website. And what happens with that draft is suddenly we're back to the language that was in the proposed regs. So it appears, we don't know why this happened, but for whatever reason, in December we got a document, a draft version of Publication 535 that indicated that real estate agents, real estate brokers, insurance agents, insurance brokers, and intellectual property brokers were all going to be considered to be specified service trader businesses. Now, the new language doesn't mention intellectual property brokers because they never were mentioned in the proposed reg either. But they do tell us that real estate agents and brokers and insurance agents or brokers are not part of the SSTB. So the good news is that lump of coal that we thought realtors got over Christmas, well, it turns out that no, really, we didn't take things away from them. We actually gave them the present they got in the summer. We're just kidding. At least we hope that's the case. We're still waiting on these final regs. The other interesting thing in that document, there are a few interesting things. Sometimes you read between the lines to try to pick up some things, and there's been a lot of analysis of this publication now that we don't have the final regs. We're trying to read between the lines on this thing. One interesting thing that is in there, though, you may remember if you've discussed or had any courses that deal with the unrelated, or I should say, with the unadjusted basis immediately after acquisition of qualified property rules. That's one of the limitations on the 199 Cap A deduction that we can use is 2.5% of that plus 25% of W-2 wages is one of the two possible ways you can compute the limit. The other one's based on half of W-2 wages. Again, that only applies if you're over the threshold amount plus the phase-out range. Don't you love how simple this rule is? But in the publication 535, it tells us that, now this does not appear to change Section 1031 results, and 1031 exchanges still result in UBIA going down to the unadjusted basis of the property that was turned over, that was relinquished. But they now say that we get a pure carryover of the UBIA for other tax-free transactions like 351 transactions when we form a corporation, 721 we contribute property to a partnership. Those no longer will reduce the basis. We're going to cross our fingers that change really is in the final regulations. Hope like mad. Cross your fingers and hope. We certainly are going to be hoping that'll be our background for this. That change would be one that we would all greatly appreciate, I think, if we had that particular change. Okay, well, since I want to duplicate this slide, must be it's important. People do tend to think it is. This is Internal Revenue Services, basically news release 2019-01, issued on January the 7th of 2019. And what happens here is the IRS now tells us the filing season will begin on January the 28th. So basically, this podcast officially publishes on the 14th. So 2 weeks from then, the IRS will begin accepting individual returns electronically. They are already accepting business returns, and they will begin processing refunds at that time. That's probably the most, for a lot of people who do early filing, that's why they're filing early. So that's probably the big deal. This is all despite the combination of the shutdown and all the Tax Cuts and Jobs Act issues. Now, caveat for that, the Tax Cuts and Job Act issues probably mean that a number of forms will not be released in final form, until well into tax season. So don't be surprised if there are still a number of taxpayers who are affected by a TCJA provision for which all the forms or other information is not gone final, that you won't be able to file electronically right away. We'll see how long that delay works. Also, let's be totally honest as well, there'll be ones we don't want to file early because even if we could, Like, right now, there's going to be no form for 199 Cap A. There's just a single line entry on Form 1040. For that reason, I have no doubt that January 28th, the IRS will accept a tax return with 199 Cap A deduction claimed. But the problem we've got is we don't really know how to compute that deduction. And so we probably are going to be holding those. Also, in some states, we are looking at the fact that the states, like my own home state of Arizona, still has to make up its mind about whether or not they're going to really conform to this law. So with all of that, I'm not planning on having a huge number of returns to file on January 28th, but if that's important to you, we now have that date. One key problem we have, though, is how the system is going to work. We're still waiting on the IRS's formal plan for dealing with the shutdown, as well as how many employees are going to be called back to handle this. That could be huge. Right now, as many people are discovering, there are problems. For instance, if you have a client with a collection issue right now, there's nobody to talk to, right? You have a problem, you have an issue, there's nobody to call. The Taxpayers Advocate Office is shut down. We can't access them. As well, you really can't get through to an agent or somebody on the phone to try to straighten out, let's say, some IRS notice problem you've got with the clock running. That's going to be interesting. The IRS still has not published their formal, during processing season, how do we handle a government shutdown ruling? We'll see if that does come eventually here. Finally, little detail for you if you hadn't noticed this, and it was pointed out this week online by Bob Keebler, and so I thought I would tell people about this since it is somewhat, important to know that this is happening, and it's a little bit quirky because we have two different start dates for this. The IRS is changing where gift and estate tax returns are filed. Previously, we filed 706s and 709s in Covington, Kentucky, or Cincinnati, Ohio. The mailing address was Cincinnati. The actual service centers in Covington. Covington, if you're not aware of the area, Covington, Kentucky is just across the Ohio River from Cincinnati. So basically, we're filing to the Cincinnati area, right? But the actual processing centers in Covington. The IRS is now taking estate and gift tax returns away from that office and moving them to Kansas City. So we'll file the returns in Kansas City, Missouri. For gift tax returns, the Kansas City address will take effect on January 1st of 18. So right now, any 709 you're filing goes to Kansas City. However, if you're working with an estate tax return, those we're going to keep sending those to Covington or Cincinnati, depending upon whether you're using a private delivery service or mailing, all the way until the end of June. On July 1st, we'll start filing those in Kentucky. The actual addresses, by the way, which is both the regular address and the private delivery service address, using an approved private delivery service, are available in the publication for this week. So you want to download that. You can grab it. They're also on the website in the articles on the website. Well, it's one of those fun times, as I say. We're getting middle of January. We're actually getting really close to tax season and really close to not a whole lot of CPE to go with. We are still doing courses, and I'm still doing courses at this point that talk about the 199 Cap A and some Tax Cuts and Jobs Act issues. I'm doing quite a few for firms that have set me up for coming in to do those sessions. Still have some sessions to do for state societies for Arizona. I have a session to do. We have a couple of webcasts coming up in Idaho. And if we actually get the final 199 Cap A regs, I wouldn't be surprised to see us add a couple of other sessions, webcasts, maybe even live, though that gets really tough to do as we get close to people really getting into tax season. But we'll keep our eyes open on that. Certainly check your state society. I know, as I've said before, most state societies had some sort of, getting up to speed on 199 Cap A or Tax Cuts and Jobs Act program of some sort offered this month, either on their own or, going with one that's being published nationally. So take a look at that. Be sure to sign up for those. We're running out of time now. You're going to have to actually start doing returns on these issues. This has been the current federal tax developments for the week of January 14th, brought to you by Kaplan Professional Education, your state society of CPAs. If you want to catch the regular updates, we do publish online at currentfederaltaxdevelopments.com. We have our current updates, what's happening there. If you want to send me a question or comment, my email address, edzollers@currentfederaltaxdevelopments.com. My Twitter handle, @edzollers. I do post things there. I also, as I note, follow the Connect groups for the Minnesota Society, New Jersey Society, and my home society here in Arizona, as well as follow the Cal CPA's Tax Talk group, which, by the way, that last one, any CPA can join. It's a Yahoo group, and you have to go Yahoo groups, and then you get into, and you search for Tax Talk, you ask for permission to get in, you can get in there. I also follow discussions on the subreddit /r/taxpros on Reddit, so you can take a look there to find some stuff. You have questions, you can pose them there, and we'll have a, not only do I take a look at them, but we'll have a bunch of other people be able to take a look and help you in that regard. It's going to be an interesting week. Again, we do not know when the Cap A regs are coming out. That's obviously the thing we are all sitting waiting on, is 199 Cap A's final regulations when they come down. That's going to be an important thing. We do know already, I'll give you a warning, a head start, already had this week written up. We discovered we're going to talk next week about the Supreme Court going to a new area of state taxation after dealing with sales taxes and when the state can tax. We're going to next week look at the Supreme Court deciding to pick up in a whole new area of how states can tax trusts. Fair warning, that's coming up next week. We'll also have any other developments that come during the week. I'm certain at least the IRS will issue some forms. We'll have some notice things. We may have some other things to look at, maybe review last year, some other TCJA review items. Just never know. We'll certainly have something next weekend, or I should say I'll record next weekend, officially published next Monday, to go over so we can take a look here and deal with the tax updates. Until then, be sure to tune back in next week for the latest edition of Current Federal Tax Developments.